From the morning reading, the spiders, diamonds, Qs, and IWM all form hammer in a bull flag price pattern. Oil rises day 5. The VIX falls. 6 of 9 sectors moved higher on Wednesday. XLU, XLF, and XLE were the strongest sectors, while XLY was the weakest sector. Oil futures rose 53 cents to close at 46.94. Breadth strengthened compared to the prior session as decliners led 1552 to 1407 on the New York Stock Exchange and led 1482 to 1046 on the NASDAQ. Oil rose for the 5th straight day in 9 of the past 11 days and continues to move toward its June high of 51.67. The spiders, diamonds, Qs, and IWM formed a hammer on Wednesday in a day 2 of a bull flag pattern. On the S&P 500 snapshot, a slender gain in the FOMC minutes. On a day absent of economic data, all eyes that weren't on vacation were focused on the 2 p.m. release of the July FOMC minutes. The S&P 500 dropped at the open, sold off to its negative 0.44% intraday low in the late morning, and then recovered in the vicinity of yesterday's close. Today's Fed effect was minimal. The relative small spike in volume was accompanied by less fast trade volatility than we usually see on Fed Wednesdays. The 500 ended the day with a modest 0.19% gain, a tad below its 0.23% intraday high shortly before the final bell. The yield on the 10-year note dropped a single basis point to close at 1.56%. The S&P has traded above its 20-day average for more than 30 days. As a measure of short-term trend, the 20-day average is a popular and decent guide, and the current streak of 33 days above that indicator is among the largest since the 2009 bear market bottom, but isn't to the point that indicates it's necessarily too much. High-yield bonds have enjoyed a solid 6-month rally. Since the low in February, the average discount on high-yield bonds has shrunk to almost nothing, and an overwhelming number of high-yield bonds have soared to 52-week highs. The daily advance decline figure for the high-yield market has shown extreme momentum as well and has reached its second highest level in more than a decade. The optimism index on the British pound has dropped below 20. Since 1991, there have been only 71 days when the Optex was below 20, accounting for about 1% of all trading days. The pound's most consistent performance going forward was over the next month when it tended to rally. The only real exception to this was the meltdown during 2008 when it continued to decline. Outside of 2008, the pound rallied during the next month after 40 out of 42 days, averaging plus 1.4%. Its maximum loss during the month averaged a negative 0.6% versus a maximum gain that averaged 2.4%. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:40 a.m. Mountain Time, and I'm recording this in preparation for the market day of August the 18th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. There we go. And at the time of this cut, we're modestly down on all 4 U.S. broad market indices, and all 4 of them just below scratch. Crude oil is up about 0.42%. Euro is up about 0.25%. Bonds are up just over scratch, and gold is up almost 0.6%. China is down just below scratch. Hong Kong, though, solidly up at about 1%. Japan, though, down about 1.5%. Germany up just above scratch. United Kingdom at scratch. In terms of macroeconomic reports for today, with a focus on the United States, we have Philly Fed manufacturing, the weekly unemployment claims, FOMC member Dudley speaking, and nat gas storage report. Looking forward to tomorrow, there's nothing on the U.S. calendar. terms of current volatility conditions, short-term VIX is at a 10.76, skew a bit more elevated this time at a 136.71, so that's definitely in the warning area. IV percentiles continue their streak of extremely low levels and coming in on the S&P at a 3, the Russell a 6, the NASDAQ a 5, and the Dow a 3. Standard deviation moves on the indices, there was none yesterday. In terms of the current charts, let's go ahead and go to... Here's the S&P futures chart. You see the big intraday swing that we had yesterday, and I say big in relative terms. We've had such small ranges lately that anything with this big a tail kind of is, tracks a little bit of attention. But this was on the strength of the FOMC minutes release. We had big swing there and ended up on the S&P futures chart at least with a small gain for the day. Right now, the overnight action has pretty much nullified that. But again, very small body and just all within itself, really. So you basically have this action where we're looking for a bull flag pattern. And right now, any kind of move up would probably trigger that bull flag. So I don't know if this is going to be just a 2-day bull flag and then fire off and set up another leg up. Certainly we've had that recently where you had... a number of these, here's a bearish engulfing, and then just, 3 days later, you fired off the next leg. Here you had a little bit of a pullback, and about 3 days later, you fired off the next leg, and then about 3 days later here as well. So most of these flag patterns have taken a few days to be able to set up and fire off in recent history. But these patterns are so small and so compressed, volatility is so low, legs are relatively short to both directions with only the slight bias to the bullish side and, these incremental new highs. So benefit risk ratios, there's not a lot of risk on the market right now in terms of if you're setting relatively tight stops. At the same time, you're not getting very far either. So it's kind of a short-term or probably not even a swing trader's market right now in that the legs are just so short. Probably just short-term intraday type traders are probably having nominal success in this tight action right now. If you're a very, very long-term trader, then you can just patiently wait for it to finally resolve in your direction. In between that is probably pretty hard. So just kind of keep all that in mind until we get some sort of energy and momentum coming back into the market, and that might not be until after Labor Day. Okay, in the Dow, same pattern, nothing there to get excited about. NASDAQ, also we had the same relative pattern yesterday. Now the pattern going into the hammer was different. The NASDAQ has been on a tear, so just kind of keep that in mind. Pullbacks might be shorter with the NASDAQ before you get a continuation pattern to the top side. And then the Russell, of course, it also had a hammer, though its pattern has perhaps also been a little bit of an alternate from what we've been on the S&P and the Dow. We get the new high and then been retracing, and we're basically still retracing on that pattern. And yesterday's action, with the futures at least, was a negative day, albeit a small body. Again, a hammer on that one as well. Let's take a look at some of these other markets. Gold continues to bedevil the bottom edge of this triangle pattern. And we're just going to continue to leave that triangle pattern in play until it basically invalidates it. It's just, it's wiggling all over the edge of the pattern. But, when it's all said and done and it closes for the day, it seems to be right there around that area of the triangle support area. So obviously we're coming into the apex, and normally you don't get this far into the apex before it breaks one way or the other. I suspect we're going to end up redrawing this triangle into something of a rectangle pattern, but right now it still seems to be playing. Gold would seem to be, the probabilities are to the long side. That's the intermediate term pattern. It's above the cloud. It's above all the key moving average lines. The expectation is that this would break to the long side. So this is actually a decent place to set up a swing entry if you've not already done so. Just know that, wow, you may have to be patient because this has been the super sloppy trading pattern of the year. In terms of crude oil has been on a tear to the upside, and right now is setting up for a cloud breakout. So quite a statement by the oil bulls of the last couple of weeks to be able to go from $39 and change up here to running into $48. That's a huge move in a relatively short time, especially bullish for crude oil. In terms of the bonds still in that sideways, now neutral pattern into the cloud, and no real indication as to which direction it's going to break out of that cloud. Normally I would expect it to be bullish, and that would signal some weakness in the equities, but it's now denigrated down into the cloud, which is neutral, so that's taken off some of that bullish patterns power, I would suspect. Okay, let's take a look at volatility. Volatility we've been talking about recently, down here around the 3-year low range. So it's had a little bit of a pop. Yesterday's pop with the morning action brought it up into, well into the 13 handle. But then after the FOMC report, basically scrubbed everything off. And right now it is trading around the 12.5. So very, very low. It's near the bottom window of our normal threshold for trading option income strategies, as a matter of fact. Let's go ahead and go over to the daily report. Not much in the way of change from yesterday. Yesterday, remember, with that hammer pattern, you really didn't achieve much one side or the other. Intermediate term phase opinion, bull flags, phase 3, and the 3 market timing signals. The first one from IBD, confirmed uptrend, GMI index a 5 out of 6, and a GMI 2 a 7 out of 8 with a buy signal in place in 7-1. Decision point scoreboard, still these mixed signals on the short and intermediate term across the various indices. So very, very choppy action predicted from those indicators at this point. In terms of the position sizing opinions, also both still at 100%. Intermediate term market posture, severely strong bulls. They're still all up above 90, really have given up very, very little in terms of weakness in this recent pattern. Also supported by the bullish sentiment line. Overall trend strength is high. Hedge warning status 0+, normal with some cautionary aspects. In terms of special opinions, no changes from yesterday. VIX is in the acceptable window to initiate new positions for novice traders. We're up over 12 now. Cover calls and put selling also acceptable to initiate new positions. The only thing I'd caveat on this of late I've been talking about with put selling, might want to wait for this bull flag to set up on your individual watch list charts and try to set up entries at advantageous locations. In terms of the specific warnings, you see that we continue to kind of build on the red in this area. It's the same 4 as yesterday, but actually we could probably elevate this one now. It's now up over 135, so it's about a 12% probability of a 2 standard deviation move in the next 30 days. You also have this distribution day count on both the NASDAQ and the S&P up at warning level, and then of course this expectation that volatility will increase as a result of these 2 indicators at some time in the future. Trend based though, it's all very, very bullish. We almost triggered the threshold for warning on this indicator. 300 would have been warning status, so certainly approaching warning status there. Key intermarket risk aversion indicators, still 3 of them is risk on, 2 is wrapped around each other and are in neutral stance. Sentiment, we have intermediate term sentiment somewhat elevated, and you see the fear and greed index in the upper quartile at a 76, so that is also, an extreme greed sentiment. In terms of the sector specific, the ones of note, though we had some improvement in utilities yesterday, it was the big winner at 1.48% increase. Its market posture in the short to intermediate and into the long term are all still relatively weak. So we'll see if that is just a bit of a bounce in that weakness or if there's something more and we start to see those turn. Also very weak is telecom, another defensive sector, and then consumer discretionary, also quite neutral. So that's a high beta area. Also healthcare and materials still have some weakness in their market postures. Mentioned utilities. We also have staples did relatively well yesterday. Telecom was also positive. So the more defensive sectors had, probably the better day than the risk on market, though there were some exceptions such as financials. And that should be enough for today. Let's go ahead and wrap this thing up. I'll scroll through this. If you see something that you're interested in, just hit the pause button, get the details. Disclaimers as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down near the bottom for the full set of disclosures. We'll see you back here for the next trading session from Falcon Global with our market preview. Manage that risk and you'll find that everything will follow through for you. And in the meantime, always persist in going out there and learning something each and every day.